Hello and welcome to our presentation by Franklin Templeton titled Uncharted Waters. We'll go over the current market environment, the market environment at the beginning of the year, and our outlook going forward. My name is Josh Nates. I'm a senior financial advisor with Wright-Patt. So we'll put the current shocks we've gone through this year into some historical perspective. We'll talk about what we're going through emotionally and mentally and how to live with the volatility going forward. So what's happening in the markets? Over the last 10 years, as we know, the market has gone up pretty much the entire time, and it's averaged 13.15% over the past 10 years. We've had a little bit of trouble here recently, and we have a pretty good handle on what happened there. So in China, they reported the first cases of coronavirus. Shortly thereafter, the WHO declared an international public health emergency. The coronavirus sent the markets falling to the deepest levels since 2018. WHO declared a pandemic. The Fed announced support for the markets to help stabilize them. The president issued aims at reopening part of the economy. We reached over 1 million confirmed coronavirus cases. The UN predicted that the GDP worldwide would shrink 3.2% for the year. The House passed $3.2 trillion in stimulus relief, and part of the country started easing restrictions in May, and we also had the police brutality protests. So let's put some of those different events into historical perspective. This is a chart showing you the bull and bear markets over the last 50 years. You can see the declines, put those in perspective with the gains during the bull markets. The most recent one was a 34% drop with a 37% increase, but that is as of May of this year. So on average, a bull market lasts 7 years and 4 months, and the bear market lasts about 13 months. You can see there the returns of the bull market way outpace any losses during bear markets. So bull markets and bear markets are just part of investing. Over the last 50 years, these are the frequency and occurrences of different size declines. As you can see, a 5 or 10% pullback is very normal, and you should expect that to occur pretty regularly. A 20% or more pullback, those are more rare. That's still something we need to be prepared for. So this chart just shows us that there's been other viruses in the past. The markets have rebounded from them. No, I don't believe any of them have been as bad as the recent one. The SARS outbreak and the swine flu outbreak on the chart there, those kind of coincide with some other market events we had. The Great Recession in 08 and 09, and then the 2-year bear market we had there after the tech boom in 03. So COVID-19 has been unprecedented, shutting down economies and governments all across the world. What I want to do now is go over some other factors that might help put some of these booms and busts in perspective for you, especially the most recent one, as we have seen the economy fall pretty sharply and steadily. Unemployment is higher now than it was in 08 and 09, but the markets have rallied pretty substantially and continue to rally. So what you'll see in this chart is the tech boom and bust in the 2000s is that peak in the middle of the chart there. The black line that kind of goes through the middle is a moving average. and then over on the end, you'll see where we are currently. So a lot of my clients recently have been asking me, okay, the economy is doing terribly. The NASDAQ is at all-time highs, way outpacing where it was in the tech boom of the early 2000s. How is that possible? Well, this chart shows the recent balance trends of the Federal Reserve. So back in 08, 09, the Federal Reserve balance sheet was less than $1 trillion. When the financial crisis happened, balance sheet went up to around 2 trillion, a little bit under 2 trillion, and has basically been growing ever since. Now, back at the end of 2018, we saw the Federal Reserve try to reduce that balance sheet a little bit, which is what you'll see of the curve falling off there, more towards the right side of the chart. But if you'll remember, back in December, we had about a 20% sell-off in the markets, but that was recently, pretty quickly recouped. And you can see that the Federal Reserve started adding some liquidity back into the markets and helped stabilize them again. But this year, with the coronavirus, the Fed has put about $4 trillion, $3 trillion into the markets. So the current balance sheet is over 6 trillion, almost $7 trillion. So this is just showing you the liquidity that the Fed has been adding into the markets basically since 09 to help stabilize the markets and keep financial assets growing, basically. This chart shows the M2 money supply. So M2 money supply is basically all liquid assets, all cash, all savings, checking deposits, all available money in the economy. So this is basically the money supply in all of its forms. And you can see that from the 80s, that has been growing pretty substantially. This next chart shows you the velocity of money. So while the supply of money has been increasing since about the tech boom in 2000, the speed at which that money moves through the economy has been decreasing. So that money basically has been going into financial assets like stocks, bonds, real estate, and not into the economy directly. So you see the speed in which that money travels through the economy decreasing. That is it for our first series. Please stay tuned and come back for our second series, what's going on in our heads and what we're going through emotionally. Thank you.